Hi everyone, so I recently did the math with the fixed expenses in my life that include things like rent, loan repayment costs, food, and subscriptions. Fixed costs are all the recurring payments in my life that I know will come up every month. And because of the things that I can allocate for business expenses and because of my software engineering salary, I found out that outside of my fixed expenses, I have $5,112 a month to allocate to guilt-free spending, savings, and investments. Today I'll be figuring out my investment and saving strategy with you, and I'll show you everything that I'm considering when determining the amounts I'm allocating to savings, investments, and guilt-free spending. And I'll also show you all what kinds of accounts I'll keep my money in, as well as take a deep dive into the stocks I'll actually be investing in. Stick around till later in this video where I go over the 3 main investment categories that I'm thinking about. Also, I'll share my screen and actually look through various ETFs that intrigue me and ultimately decide on my allocation moving forward. If you're wondering how I was able to get to over $5,000 a month outside of my fixed expenses, I can make a video breaking down more specifically what my monthly expenses and income are, but let's talk about allocating this $5,100. In order to properly allocate towards the right things, I need to think about the context that I'm in, because context is everything. Right now, I'm 25 years old. I'm in the industry of software engineering, and I have businesses that provide me additional income. I'm making great money as a senior software engineer and have already received a decent chunk of equity in the current startup I'm working at as well. And equity aside, there's still plenty of headroom for growth with engineering titles like staff or principal engineering, or more leadership roles if I choose those directions. All of this to say that my annual salary will only continue to increase, which in turn will give me even more to invest in the future, so I can be objectively more aggressive on how I allocate my money in the near future. First off, I hate keeping cash, especially with how inflation has been the last couple of years and the health of the stock market right now. I feel guilty holding any substantial amount of cash. I'm not trying to buy a house or a car anytime soon, so I've been against holding cash. But if you're familiar with my story, you know that over the last 3 years, I've also been recovering from 2 autoimmune kidney diseases that just set me back quite a bit. That recovery was not only mentally and physically draining, but also financially. I've also been a part of 2 separate startups that got millions in funding and seemed very promising, but ultimately fell apart. Being on the other side of those situations, I don't want to be investing all of my available money moving forward in case I have to deal with something unexpected like the things that I experienced. So let me actually pull up my 2024 investment plan spreadsheet so that we can fill this out together as we look over the different aspects that I'm thinking about. So given what I just said, for a compromise with myself, I'll be putting aside $1,000 every month to high yield savings. And to be clear, this money won't just be put inside a mattress or even in my checking account. These will be put into my Ally money market account, and that's why I have that listed here, which right now, Ally money market accounts here in the US give a 4.25% annual yield. This just means that every $100 I put into this account, I should have an additional $4.35 a year later. Because this value compounds, that APY will translate to a ton of money in the future if I stick to this plan. So let's actually take a look at how much money I'll make by putting it into a money market account versus just my checking account, for example. So just to give you all more context and to just put into perspective how much more money you'll be making by putting your money into a money market account versus just a checking account, let's look at a compound interest calculator. I can just go to Google compound interest calculator, and this one by investor.gov is one that I use quite a bit. So from here, we can see that an initial investment of $1,000, because right now I'm trying to invest $1,000 a month, or not invest, but put into my savings. But in theory, with the percentage yields, we're treating this like a compounding investment for the sake of this calculation. So the initial investment is $1,000, monthly contribution is another $1,000. Length of time, I'm going to put somewhere 20 to 30 years just to show some sort of growth over time. Let's say 25, just to be conservative. So right now I'm 25. This is the money that will be in this account when I'm 50, if I continue to invest at this specific rate. So the estimated interest rate is the 4.25%, and the interest rate variance, I'll put this at like a percent, so this means that it can drop down to 3.25% or it can go up to 5.25%, just depending on the specific market at that time. And this will compound annually because this is the APY we're looking at. So in 25 years, that $1,000 a month invested will be $519.748. The lower bound of that being closer to 450,000 and the upper bound being closer to 600,000. That being said, what would the cash just be, right? Because that's what we're comparing it to. So we can actually just get, I'll just Google like the calculation. We're talking about 1,000 a month times 12, or times, 12 to get the yearly amount that we're investing times the 25 years. And this gets us to 300,000. So over 25 years, we're investing cash $300,000. And if we look at the compounding interest calculator, that $300,000 can turn into about $500,000, which is a $200,000 difference. So I'm saying this just to stress the fact that putting your money into a high yield savings account or even investments can do so much more for you and work while you're sleeping as everything compounds year after year. So that's just something to keep in mind. Okay, so now that we know how much we're going to allocate to savings, let's figure out what I want to do with the $4,112 left that I have to spend every month. Again, I feel proud and grateful to be in a position where these are the types of decisions that I have to think about, but hopefully being open and transparent with this thought process can help you regardless of the actual amount that you can use to invest. And if you want to be part of my journey of helping others unlock their true potential while feeling happy and fulfilled in the process, please take a moment to like this video and subscribe. So in my more costly months, like between November and February, where I have the holidays that include traveling and gifts, as well as Valentine's Day, my girlfriend's birthday, and our anniversary, I've typically spent anywhere between $1,000 and $1,500 a month outside of fixed spending. Taking this as the benchmark in order to make an investment strategy that I know I can stick to, I will say that I'll allocate $1,112 a month to guilt-free spending. This is knowing that in months where I'm just at home, I don't get close to that $1,000 spend, so I'll be able to accumulate more cash in order to pay for the more expensive months when they do come. This also makes it so that I can have a round number of $3,000 to invest every month. So now that I have $3,000 to invest every month, let's figure out how this will be distributed between investments, and then I can discuss how often I will be investing. With the $3,000, I want to put my money into 3 equal buckets. 1 includes safe investments that I don't expect to be volatile. 2 is relatively safe investments that may be volatile in the short run, but should be generally safe in the long run. And 3, riskier investments that are even more volatile, but again, will most likely beat the broader market in terms of growth over the next couple of decades. Right now, I'm thinking about things in a longer time horizon, talking about 20 to 30 years, so I can inherently be more risky. So let's start with the safe investments that I don't expect to be volatile. For this category, I'm solely looking at ETFs. If you didn't know what an ETF was, it's basically a basket of stocks. Each ETF determines their weight of different stocks dynamically, so you don't have to. And because these ETFs hold such a variety of stocks, they're more resilient to any drop of price that any one stock in the portfolio may experience, and they just are a little bit more resilient in market conditions because of this. For me, the options fundamentally come down to either ETFs that track the S&P 500, like ticker symbol VOO, or SPY, or an ETF like ticker symbol SCHD that is actually a heavy dividend yielding stock. I honestly don't get drawn to any one stock because of dividend yield alone, because I know that over time the compounded return of the stock's value itself will be much more than the dividend return. But let's actually take a look at both of these ETFs. So looking at Seeking Alpha, which is a good site if you want to look at a stock or ETF's previous history, I can see that VOO, which again is the ETF that tracks the S&P 500, is doing very well. It's up 31% on the year. It's up 82% over the last 5 years, and it's up 180% in the last 10 years. So this is something that will be resilient, should over long periods of time continue to go up at a consistent rate. And you can even see when COVID happened, there was this giant plummeting of the stock market, but it shortly passed that point that it was previously high at, and we've since blown that right out of the water. So even world events like the global pandemic weren't enough to drag this stock market down for too long. So this is why I feel like this is a generally good investment moving forward. Similarly, we have the SCHD ETF, and this ETF is popular because of the dividend yields it gives. And by dividends, it means that, you get part of the profit of these different companies paid out to you at certain periods throughout the year. So you'll actually get a cash return back on your investment without actually having to sell any of your assets at any one time. So some people build up large dividend portfolios and then use that as their paychecks every month to pay bills instead of having to sell different individual stocks or ETFs. As you can see, the actual increase in price is not as much, where we're seeing the 10-year appreciation being close to 114%, whereas in the S&P 500, this was 180%. I will note that SCHD is historically less volatile year to year. The stock market can have a down year and it won't fluctuate as much. Let's see if we can actually see that in charts. So the last 6 months, it's been up 7%, whereas the last 6 months in the SPY has been up 16%. You can see that generally it goes in the same direction and it shows generally the same shape, but the magnitude will be a lot different. In years like this, where the stock market is doing very well, you'll see that it doesn't raise as much. But in years where the stock market doesn't do so hot and is down, say, 15%, SCHD will probably be down closer to 5% or maybe even 1% because it's just less volatile. But again, because of how much time I'm considering with my investments, I'm probably just going to go with ticker symbol VOO. The expense ratio is only 0.03%, and so that's how much they're charging for all of this, the services like that Vanguard is doing to put together this ETF automatically. And in general, I'm looking for returns 20, 30 years down the line. And I really don't care about the volatility in the medium term because I won't be selling anytime soon. So the first thing that I'm putting in my investment plan is that $1,000 a month. And I will be putting it into ticker symbol VOO. And I would probably be holding these in something like Fidelity or my public account, just so that I can have access to it if I ever wanted to see any updates in the market and see what my portfolio is looking like. Now let's get into my second category, investments. Again, this category is supposed to be still relatively safe. I'm keeping things safe by still looking at ETFs that have historically gotten great returns over decades, but some that are also more volatile in nature. For this category, I wanted to focus on tech. With how much Nvidia has exploded recently, I think it's a clear sign that with the advent of AI and even more tech companies popping up, technology still has so much more headroom in the next couple of decades to grow in ways that probably we've never seen before. But what does it mean for me and my investment portfolio? Well, it means that I want as much exposure to that tech growth as possible. And with that, let's look at some ETFs that I'm considering and why. So I've pulled up this page comparing VOO to VGT, where VGT is the Vanguard Information Technology ETF that really just focuses on the tech sectors. And as you can see, generally they go up and down similarly. Like when one is down, the other's down. When one is up, the other's up. But the magnitude that VGT does go up and down is more. Similar to how I was talking about VOO versus the SCHD, I don't really care about the short-term volatility. I want the growth over time. And I think right now it's undeniable that over time, the tech sector is just going to continue to balloon because we're only at the very early stages of AI. Right now, autonomous cars still aren't fully a thing. Right now, AI is still at its primitive stages to really what it can do in the future. So I truly believe in it. And looking at these charts, we can see that VGT continues to grow at faster rates than the S&P 500 does. And because I have that 1,000 going into savings every month, because I am putting money into the S&P 500, I even feel comfortable with something even more volatile than VGT. And that's why I want to even look at some other ETFs. With VGT, one of the downfalls of VGT is that a lot of the prosperous tech companies are also in the S&P 500. So I'm now just making sure that there isn't too much overlap. This overlap by weight just shows how much of each stock that each ETF has, and then seeing that overlap, we can see that it's around 30%. That's actually less than I expected, so I'm okay with that. And I think it'll just give me the exposure that I want to the companies that I want moving forward. So another ETF that I can consider for this category that I'm trying to invest in, which is technology, which is more volatile but should grow over time, is this SMH semiconductor ETF. Because of NVIDIA and how much it's grown in a relatively short amount of time, this ETF specifically has grown 72% in this last year. It's grown 312% in the last 5 years. And in the last 10 years, it's grown 884%. Granted, you can see that a lot of these jumps in price happen in these one moments of time. Like between 2015 and 2018, it stayed fairly flat. And then there was a spike in 2020, and then there was a spike in 2021, and then now there's this spike over the course of 2023 and into 2024 that creates all of this growth. Part of me is hesitant because of just the sheer record-breaking, and I'm assuming NVIDIA has carried a lot of this. Let's look at the holdings. And so yes, 21% of this ETF is NVIDIA. So I'm a little worried that NVIDIA's growth is unsustainable at this point. I do think NVIDIA will grow in general, and I think that growth will also be reflected in VGT or VOO because it's part of the S&P 500 and it's a tech stock. So I think that I will have that exposure. Let me just confirm that a VGT, let's see, VGT, yeah, so VGT does have NVIDIA, and has 10.43% exposure. So I will still have exposure to that massive growth, but imagine if NVIDIA slows down in its growth over the next couple of years before it later grows again. I don't want to have all my eggs in one basket per se, and especially going into my next category of investments, which is even riskier. I think for this one, I'm going to stick with VGT, and I'm gonna go 1,000 a month, and also this is also going to be a Fidelity or Public, but the ticker symbol here will be VGT. Okay, so what direction will I go with my riskiest investment category? If you haven't already predicted so, I'm going with crypto. I feel like even just 5 or so years ago, this might have been a much more controversial add to my portfolio, but given that we now have things like a Bitcoin ETF and actual investment firms buying crypto themselves, I feel as if we're in a safer time to invest in crypto while still having huge potential upside as more worldwide acceptance of crypto comes into fruition. Similarly to the discussions that we had before, I actually want to break up my crypto investments into safer investments and riskier ones, where I view things like Bitcoin and Ethereum as like the equivalents of VOO and VGT. And altcoins are the riskier investments that have more potential room to grow. And in my choices, I'm actually not going to complicate things at all. And I'm going to look at Coinbase right now and see that by market cap, the 4 that are here. And in my choices, I'm actually not going to complicate things at all. And I'm going to split this allocation between Bitcoin, Ethereum, Solana, and Cardano. With Bitcoin and Ethereum, I have a lot of confidence. That they will continue to grow, but I'm just unsure of how high they can actually grow. And with Solana and Cardano, I get exposure to a little bit more growth with cryptocurrencies that I've heard in the day-to-day and I heard people talk about. So I feel confident that they will still have the investment interest over time. And it's only because I continue to hear about them and because they have large market caps that I'm willing to invest in these. But to be clear, they will be at a much lower allocation. So for the $1,000 a month that I'll be investing in crypto, all of this being done on Coinbase, I will be putting $400 a month into BTC. I will be putting $400 a month into ETH. I will be putting $100 a month into Sol and $100 a month into ADA. And to just touch on Coinbase for a second, right now, as I'm building my portfolio, I feel comfortable putting it there. We're not talking ridiculous magnitudes of money yet. So until we get there, I will keep it on the platform. And if we do get to larger amounts of money, then I'll consider things like hardware wallets to store the cryptocurrencies. So in terms of allocation, this means that $1,000 is going to my Ally money market savings account. $1,112 is being reserved for guilt-free spending, and this means like trips, gifts, outings, like anything outside of my fixed expenses every month. Safe investments are $1,000, and this will be done by investing into VOO, which tracks the S&P 500. My slightly volatile but more room for growth investments will be into VGT, so we can track all of the tech stocks and the tech growth that happens over the next couple of decades. And finally, for more riskier investments, we have cryptocurrencies. Understand that Out of the $5,112 a month, less than 20% is going into crypto, and the rest is getting deployed to either my life or savings or investments. So it's still generally a lower allocation, and this is all just to manage my risk, even in the long term and the long-term time horizon that I have for my investments. So just keep that in mind. Now let's talk about frequency. Because I get most of my money in chunks twice a month, that's a logical time to disperse investments so you don't see the cash. But in order to maximize the effect of an investment strategy called dollar cost averaging, I'll be investing daily for as much as I can moving forward. With dollar cost averaging, I intend to buy the same cash amount of stock or crypto every day, regardless of what the price is. This should overall reduce the cost basis of each of the investment assets because I'll be buying more fractional portions of the stock or crypto whenever the price is lower and less portions when the price is higher. For crypto, I can perfectly break this up daily because the market is open 24/7, whereas the stock market isn't open on holidays or weekends. So those purchases must be split over the course of the 21 days a month that the stock market is open. Either way, I think spreading out the investments throughout the month will help me in the long run, and I also think mentally investing every day will stop me from looking at price changes on a day-to-day, since I will cause my portfolio to jump a bit with each investment anyway. So the math with investing every day comes out to $47.62 invested every business day to each of VOO and VGT, about $13.33 invested daily into each of Bitcoin and Ethereum, and finally about $3.33 daily into each of Solana and Cardano. Okay, so that was a decently long discussion and exercise, so I'm going to end it right there. Let me know if you want to see more videos like this in the comment section below, and as always, stay positive, stay inspired, and I'll see you in the next one.